Welcome to this explainer. Today, we're taking a deep dive into a fundamental rewiring of how businesses in India report their impact, their risks, and, frankly, their reality. We're turning complex regulatory shifts into clear, actionable strategies for your corporate survival.
Picture this for a second. Your statutory financial audit is going absolutely perfectly. Your balance sheets are pristine, your P&L is flawless. But suddenly, your entire company gets flagged. Why? Because nobody can find a raw fuel consumption log from a manufacturing facility 300 kilometers away. That is the bold new reality we're facing right now. SEBI, the Securities and Exchange Board of India, has fundamentally changed the rules of the game. Sustainability is no longer a corporate marketing brochure filled with stock photos of trees. It's an auditable balance sheet.
So, here is our game plan for today. 1. A high-stakes audit. 2. Why comply or explain is dead. 3. Inside the audit room. 4. Hidden risks to your board and supply chain. And 5. A concrete action plan for company.
All right, let's jump straight into part 1, a high-stakes audit. Look, the stakes for corporate sustainability reporting have completely shifted from voluntary goodwill to stringent, mandatory, financial-grade compliance. And this isn't some distant future problem. It's a current mandate. The rollout started with the top 150 listed companies by market cap in financial year 2023-24. It expanded to the top 250, and it's rapidly scaling to the top 500 in 2025-26 and finally hitting the top 1,000 by 2026-27. If your company falls into that bracket, an independent auditor is coming to verify your ESG data with the exact same rigor they apply to your financial numbers. There's literally nowhere to hide.
Which brings us to Section 2, Comply or Explain is officially dead.
You know, what's really fascinating about this shift is the total death of the old reporting model. For years, ESG reporting in India operated with a very convenient loophole. Under the old comply or explain model, if you didn't have the data for a specific metric, you could just write a really well-crafted paragraph explaining why it was missing. Well, those days are officially over. Under this new BSRCR core reality, SEBI has locked in 9 precise, undeniable ESG attributes that require hard, verifiable data. No more narrative excuses. When you compare them, there's a massive difference between the voluntary full BSRS and this laser-focused BSRS core. The full BSRS has over 130 disclosure items scattered across 9 principles, but assurance on that is totally voluntary. SEBI realized pretty quickly that auditing 130 items right out of the gate was impractical. So they carved out the BSRS core, 9 highly specific ESG attributes, like greenhouse gas emissions, water management, and gender diversity. And for these 9 attributes, external assurance is absolutely mandatory.
And here is the absolute kicker, defining the term reasonable assurance. When we say mandatory assurance here, we do not mean limited assurance, where an auditor basically just checks your math for obvious errors or typos. Reasonable assurance, under standards like SSAE 3000, means the auditor is actively testing your internal data controls and tracking your numbers all the way back to their exact raw origin. They're positively verifying the data exactly like a statutory financial audit.
Let's move on to Section 3, Inside the Audit Room.
So, what actually happens when that auditor sits across from your compliance team? Let's talk about where companies are going to fail. The first major failure point is data traceability. Imagine your company claims it reduced Scope 1 greenhouse gas emissions by 12%. Under reasonable assurance, pointing to a number in an Excel spreadsheet just won't cut it. The auditor will demand to see the raw fuel consumption logs, the physical utility meter readings, the actual refrigerant purchase invoices. Every single KPI has to trace back to a source record. If that trail breaks anywhere between the factory floor and the boardroom, the audit fails.
And they aren't just hunting for carbon data. SEBI added some uniquely Indian context metrics to the BSSR core. Auditors are going to verify job creation in smaller towns, specifically demanding to see wages categorized by RBI classifications of rural, semi-urban, urban, and metropolitan areas. They'll audit the gross wages paid to women to check for true parity, and they'll demand safety metrics like the lost time injury frequency rate. And by the way, that's not just for your permanent employees. That applies to your contract laborers as well.
Then we have the third massive failure point, methodological consistency. Look, if you change your emission calculation factors mid-year, let's say you switch from IPCC standards to national grid factors simply because it makes your final numbers look a little better, that is going to trigger an immediate red flag. Tweaking data boundaries or relying on disconnected, manual spreadsheets across different departments just creates inconsistencies that auditors will easily catch. Under BSR Core, consistency is literally just as critical as accuracy.
All right, zooming out to Section 4,
Hidden board and supply risks.
We need to talk about the secondary consequences here, because they directly affect individual directors and your wider supply chain. 25,000 rupees. That is the potential daily penalty for non-compliance under SEBI's listing obligations and disclosure requirements. But honestly, it goes so much deeper than just fines. Because these disclosures are formally part of the annual report, independent directors and the CFO can face serious personal liability risks under the Companies Act if they sign off on fabricated or heavily overstated environmental claims, greenwashing essentially, without proper due diligence.
Now here's where it cascades, the supply chain trickle-down effect. Starting in FY 2024-25, the top 250 listed companies have to report on their value chain emissions. That covers upstream and downstream partners representing 75% of their total purchases and sales. To comply with that, these massive listed companies are now forcing incredibly strict ESG data requests down to their much smaller, unlisted suppliers.
And that is exactly why unlisted small and medium enterprises, or SMEs, absolutely have to pay attention here. If an unlisted supplier can't provide reliable, auditable metrics to their top-tier corporate buyers, they are facing massive business risks. We're talking about actual vendor delisting, delayed payments tied directly to ESG clauses, triggering external audits they aren't prepared for, and even being completely excluded from export chains because of international regulations like Europe's Carbon Border Adjustment Mechanism. Make no mistake, ESG data is now a barrier to entry for B2B commerce.
Which brings us to our final section, Part 5. Action Plan for Companies.
So, how do we actually prepare for this? Let's outline a concrete 3-step survival guide so you don't walk into this blind. Step 1. Ditch the Excel chaos. You've got to move away from scattered, manual spreadsheets. You need to implement a centralized ESG data architecture that captures operational metrics right at the source and maintains a bulletproof audit trail. Step 2. Conduct a dry run. Seriously, do not wait for the real audit. Run an internal pre-assurance mock audit at least 60 days before the external assurers arrive. That gives you time to catch missing links, like those missing fuel logs we talked about, while you can still fix them. And step 3, engage assurers early and ensure strict independence. The auditor checking your ESG data cannot be the same firm providing you with ESG consulting services, per the conflict of interest rules. Because reasonable assurance requires such incredibly deep testing, waiting until the last minute leaves you with zero room to maneuver.
To wrap up this explainer, I really want to leave you with this one defining thought. ESG compliance in India is no longer an exercise in public relations, it is foundational infrastructure for corporate survival. The days of using sustainability reports as glossy marketing material are totally over. It is now a critical, rigorously audited metric of your company's actual operational competence.
So tell me, is your compliance team truly ready for reasonable assurance? Drop your biggest data hurdles in the comments below. I would absolutely love to read them. And if you found this explainer valuable, make sure to share it directly with your compliance, finance, and board teams. Trust me, they need to know it's coming. Thanks for joining me on the explainer, and I'll catch you in the next one.